My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People, my friends, I'm just trying to save you some money here. My job, not just entertain, but try to explain all this stuff. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Fraught. That's the word we use in the office for days like today when so much seems to be going wrong. Even if the averages weren't that terrible, Dow declining 137 points, S&P slipping 0.47%, NASDAQ losing 0.51%. We did catch a late-day rally in the averages. Now, we've got a budding revolt against some of the Magnificent Seven. It makes me feel like we're getting closer to the end of the movie. Maybe only 3 of the 7 make it out. Pessimistic. We've got a Fed that seems to be backing off from its optimism about inflation. The economy is too strong to justify rate cuts. Pessimistic. Oh, and there's some incredibly solid action in the healthcare stocks, the telcos, the banks, the transports, and the travel and leisure stocks. The aerospace is on fire. By the way, people, that's a huge percentage of the market. But who cares, right? We only care about tech. I think that that's wrong. Let's break them down, because if this market feels like a minefield, it's a minefield of our own choosing. There are plenty of areas with clear paths if you're willing to look. First, let's take the Fed. Today, Jay Powell once again made it clear that he's looking at the data to figure out what to do next. Sure, a few months ago, they thought that the economy was slowing in an inordinate pace. They spoke about needing to be vigilant because they feared they would fall behind if the economy really took a header. But the economy didn't take a header. Instead, I think the Fed didn't and couldn't predict the burst of economic activity that came with the election of President Trump. You know, it's a little uncanny. Is it kind of like a switch was flicked? The optimism came out of nowhere, but the business community was very happy about the election, and their optimism was palpable. Big change from how they felt under Biden. That's why the Fed chief told us today he can't stay as concerned about a slowdown. As he said today, we don't need to be in a hurry to do anything. Now, at another time, we'd be thrilled to hear that message. But there are still tons of investors betting that the Fed will keep cutting rates as the year goes on. They forget that the Fed's data dependent. And right now, the data says do nothing. They thought more rate cuts were inevitable. So then what do? They sell stocks like crazy when they don't hear that the Fed's in a hurry. Remember my view, as long as the Fed's willing to cut if the Fed economy deteriorates, we're in a good moment. We have good earnings, and for that matter, matters more than monetary policy to me. Good earnings makes stocks go higher. Good profits combined with a benign Fed equal higher stock prices. Optimistic, glass half full. You know, I hate those press conferences after the Fed speaks. I mean, that's because the press has to ask the most provocative questions, mostly referencing President Trump's statements about the need to get interest rates down. At one point, I had a job like these reporters. I was early in my career, penniless, living in the back of my car. I always tried to make some sort of wave, something that so threw off the person leading the press conference that I knew my pathetic bosses would be thrilled. They always were. I, as they say, no longer pay for dinner. I don't need to make a splash or even a ripple. I just want to tell the story. And the story is the Fed's going to have our backs if things get weak, not going to be intimidated by the president. The economy gets too strong, Fed won't help us. I see inflation potentially coming down because I think housing costs are coming down, supermarkets getting slightly better, oil's pulling back, auto prices going lower. And that's the data. I like the data. Here's what the press and many investors don't seem to realize. The delusional people want more rate cuts, but the Fed is only willing to give us that in a situation when the economy is falling apart. Fortunately, we're not in that situation. Optimistic. Think about how strong some sectors are. When the Fed slows its rate cuts, that's nirvana for banks. That's where they make the most money. See those stocks? Healthcare's been lagging from far behind. Now I think it's playing catch-up. Travel and leisure. I mean, what a bull market. No top. Which leaves the Mag 7. We always talk about these stocks as if they're invincible. As someone who shared in the creation of the term Mag 7, all I can say is, remember, the Eli Wallach's goons gunned down a bunch of them. Maybe we're near the end of the movie and some of the good guys, James Coburn, maybe Robert Vaughn, have met their demise. How about the ones that reported tonight? Microsoft delivered a strong overall quarter, but the most closely watched figure is the constant currency revenue growth for Azure, their cloud infrastructure business. That missed so slightly. In truth, the success of the quarter will be determined by Microsoft's guidance, and that should come at the end of the earnings call, which is going on right now. I ain't cuffing it. Anyone trading the stock before that's putting the cart before the horse. As for Tesla, as long as Elon Musk is behind the driver's seat, I want to own the stock. He put up soft numbers tonight, but a terrific forecast for 2025. I'll go with that. Musk delivers. Moreover, he makes cars that could become our nation's de facto autonomous vehicle king if his close associate, the President of the United States, opens the federal interstate highway system to Tesla. if only to keep us competitive with China. The best report of the night was easily Meta Platforms, which delivered a colossal top and bottom line beat, tremendous free cash flow. Meta also offered a conservative outlook, lower than expected revenue for the current quarter, but after a quick pullback, investors ignored the guidance, which you have to do, and sent the stock higher in after-hours trading. After seeing what Zuckerberg did in that latest quarter, I think it's right to look past any conservative forecast. Which brings me back to the dilemma of NVIDIA. Right now, we're trying to figure out what's really going on. Is the president going to take action against China, banning the export of NVIDIA chips? So far, that seems to have created a mother necessity situation where Chinese companies say they've developed software that gets much more out of a single chip. So we have the political pressure and earnings pressure from the possibility that companies won't need as many expensive NVIDIA chips if Chinese software gets more out of them than ours. We don't know what's worth. We can't figure out the price-to-earnings multiple. So many are heading for the hills. The only problem, we're going to step on a landmine between here and the hills. I say that NVIDIA and Apple are becoming two of the most hard stocks to own. I myself regard this as one of those moments Thomas Paine talked about. These are indeed the times that try men's souls for both NVIDIA and Apple shareholders. Is there a crisis at Apple? No, it's just facing a belief that in earnings, and more important, its forecast will give tomorrow night. It will be rough. It'll be actually terrible. Sell. NVIDIA, I fear that order cancellations are trying to be priced into the stock. I don't know if it's done yet. When it does, the stock's a buy. I just can't divine that level without more information. I'm not even going to make a claim that I have it. I'd say they're not so magnificent 6, maybe the OK 5. Why don't we wait and see? But the bottom line, if you stop focusing exclusively on big tech, then we got a great market going. And if all you care about is the Mag 7, remember the movie. Make sure you have the survivors and trust that more make it out of the village than we saw in the original. Let's go to Don in Illinois. Don.
Hi, Jim. Thank you for taking my call. I'll cut to the chase. My question is about Eaton. We all know about all the things that have been said about the data centers, and recently there's Chevron and some partners planning for energy for them. What I don't know is Eaton still a good buy at this price?
Well, we bought some earlier during the cataclysm of selling for the trust. Lower, the stock has made a comeback. They do report on Friday. I don't want to play that game of putting a gun to my head and say how they'll do. It's a long-term terrific story, and I'm not going to be distracted from the idea that one of their businesses of the 5 mega trends that they're involved in has gotten a little bit weaker. Let's go to Megan in California. Megan.
Hi, Jim. How are you?
I am good, Megan.
Thank you for taking my call.
Of course.
And thank you for all your help.
Thank
I'm a
you.
first-time caller, and I'm a member of the club.
Thank you.
And my question is, with all this noise about the DeepSeek, are you still as enthusiastic about Dell as you used to be?
That is such a great question. I think about Dell and HPE constantly, like I think about Marvell. Dell has come down a huge amount. I have faith in Michael Dell, but you know what? I also have faith in waiting to see and learning more. And we've got a very fluid situation where all those who claim that they know exactly what's going to happen with NVIDIA or Dell or HPE are, frankly, as delusional as the people that I referenced earlier. You can't know the answer. It's unknowable. And that's where we are. Look, despite the uncertainty we're facing around big tech, there's still a lot to like in this market. Let's stay focused on all stocks, not just 7. On Mad Money tonight, Chili's parent company, Brinker, there's a good example, soared to a new high on its earnings beat. I'm sitting down with the CEO to see what sparked the big appetite for the stock today. Then I kicked off my morning with behind the counter exclusive. Yes, I went behind the counter with Kava's founder and CEO. Don't miss this look at what's shaping Kava's post-IPO growth. It's terrific. And later on, controversial, Levi's is on the move after earnings. Market right now doesn't like it. I think the market might be wrong. I've got the apparel company's top brass to break down the quarter. And let's not claim what we know when we don't. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Well, you look at these incredible numbers from Brinker International, one of my faves, the parent company of Chili's and Maggiano's. I've been pounding the table on this one for well over a year because Chili's gives people great value in an environment where the consumers become very sensitive to price. But even I didn't expect results this good. Today, Brinker reported a monster top and bottom line beat, fueled by mind-blowing 31% same-store sales growth for the core Chili's brand. I didn't even know that was possible. Extra impressive when you consider that the analysts were looking for 20.5% growth, which is not a low number. Yeah, they blew the estimates out of the water. No wonder Brinker stock were more than 16% today. It's now up more than 340% over the past year. That's real money. Can it keep climbing? Let's give him to Kevin Hochman. He's the guy who did it all. The president and CEO of Brinker International and president of Chili's Grill and Bar to get a better sense of the quarter. Kevin, welcome to Mad Money.
Yeah, what a great day.
I'm just blown away. Yeah. I mean, how do you do those numbers? I mean, honestly, I'm astonished. Even as a restaurant owner, I don't know how you did it. Tell us.
Well, number one is teamwork, right? We've got these amazing restaurant field teams. We've got an amazing restaurant support center at our home office. They're co-designing plans about how to make the restaurants easier to operate. Right. They're co-designing plans on how we're going to create new food innovation and advertising to get new guests in. And it's all coming together and working. Progressively every quarter, our results are getting better and better. Now they're being fueled by 19% traffic growth. And quite frankly, we think the sky's the limit. We don't think this is the end. We think this is just the beginning of the Chili's turnaround.
Yeah, the analysts are always like, well, hold on, is this a flash in the pan? It has to end, whatever. Or maybe the ad campaign did it. You're the most consistent number getter in the whole industry. The other guys I'm worried about, I'm not worried about you. You were doing innovative things. Like, for instance, everyone in the office knows about the triple dipper. They know it from TikTok. They know it from everything. You're pervasive and you're ubiquitous.
Yeah, one of the things that we talked about at our Investor Day 2 years ago was how we were going to get back in culture. We were going to make Chili's relevant again. That means having relevant food, having a relevant experience, as well as getting back into advertising and being in a place that people consider on where we're going to go tonight for drinks or we're going to go out for dinner. That's taken hold. And what's happening is then we're in their consideration set. They're coming for the first time to Chili's, and guess what they're saying? This is a great experience. We're coming back. It's part of a rotation now. And that's why you're going to see sustainable, or you are seeing sustainable growth in our business.
Now, when people say that there's the competition among some of the restaurants for share, that's not your world. That's the value competition, just shooting at each other.
Yeah.
I want a dinner out, and I don't want to spend that much money.
Yeah, here's what I would tell you. So I had my vice presidents of operations on a call about 3 weeks ago, and I looked them in the eye and I was like, hey guys, who's worried about the new $9.99 deal from a big competitor? They all started laughing. And I'm like, why are you guys laughing? And they're like, because we've been in the gym working out the last 2 years. We know our service and our experience is so much better than that. So they can undercut us all they want. Nothing's going to happen in our business. And what's happened in the last quarter with that new offer? Our business has accelerated. So we are not worried about being undercut, because value is not just about low price. It's also about what you get in the experience.
And how you know where to put the ads, huh? It's obvious you got it.
Oh, my God. Sense. Well, we got these two guys, George Felix and Jesse Johnson. They know how to place ads. They're really into live sports that don't get, recorded. And so we're constantly getting tons of impressions. People think we spend a lot more on our advertising than we do because those guys know how to pick shows.
But when I was asking the office, I said, what's he doing all this money? There was one guy who said, listen, you ought to remake the old stores. You're getting 4 million of average unit volume. I don't know if you need to. I mean, I think you answered the questions pretty well.
Well, we started this journey. We were at $2.9 million AUV. Now we're at $4.2 million. I always said if we can just get to 4, these restaurants are going to operate a whole lot better. But here's the thing that's really exciting. We haven't touched reimaging our restaurants. And we've got 200 of our 1,200 restaurant estate that they need some love. And we've got this new design that we're working on that we call the Modern Greenville that I think is really going to excite guests. We're going to start really reimaging next year. And it's going to take a couple years to get there, but that's all upside.
Okay, but I like my Chili's. Why do I need it to look better? It never looked bad to me.
Well, the most important thing, I think a majority of our state looks great, right? But it's really important to look best on block, right? So it's not just about great food and great service, but an atmosphere that people want to hang out and they want to come back time and time again. It's very clear, post-COVID, people want a third place to come together.
Yes, they do.
And Chili's is really answering that call right now.
Now, in the call, you spent some time at Maggiano. You're going to go for it, aren't you?
So Maggiano's an exciting brand. So we got the unit economics a whole lot better. The average Maggiano's does $10 million AUVs, 18% margins. That's a lot of money on, per Maggiano. So we think there's a ton of white space. Maggiano's is the smallest brand and everybody thinks big. There's only 50 Maggiano's out there. So we've got a lot of white space to build Maggiano's. And our president, Dominique Berling, that's exactly what he's working on right now, is what's the new prototype to build our first Maggiano in over a decade.
Okay, well, we know that alcohol sales for you are roughly flat. Most of them are down big, not you. Should I go and have the resolution breaker?
Well, it's January, so you got a couple days left, and in February will be a new one. But, I'll tell you, that's been a real key to us because at the end of the day, if you go to a bar around here, you might pay $20 for a margarita. Everybody knows you don't need an app, you don't need a coupon, you don't need to come for happy hour. You can always get a $6 margarita of the month at Chili's, and it's always made with some premium tequila. And I got to tell you, that's something that our guests really appreciate about us, and they come to us for, and we're always going to be there with that $6 margarita.
I did a lot of work on this before I saw you. It's 8. Everyone else is 8. The lowest I've seen is 8 because I did a lot of work because of my wife's stuff. You are so underneath everybody in price, and it's premium. I don't know how you do it. You're really just an amazing restaurant.
It's an important thing to make sure that guests, no matter how much money they have in their pocket, they can come enjoy a casual dining experience.
They sure do. I want to congratulate you and your team. One of the few guys, by the way, let me state that I know the names of his team because he mentions them and he means it. And also, thank you for what you did for all the firefighters, which is very clear. That was very important to you in the Southland.
Yeah, I appreciate you saying that. Yeah.
I want to thank Kevin Hochman, President and CEO of Brinker International, symbol EAT, on a monster quarter. Mad Money's back, everybody.
Coming up, Cramer's getting behind the counter at Cava and catching up with the CEO to see if the chain can continue its growth in 2025. Next.
Over the past couple of years, we've had a huge win in Cava Group. Yeah, the popular Mediterranean restaurant chain came public in the summer of 2023, started recommending around 30 a few months later. I just liked it so much, and now it's at 135, thanks in part to a terrific 7.4% rally today. Still, after putting a terrific quarter in November that initially sent the stock soaring to an all-time high of 172, Cava's been hit with a wave of profit-taking. That's okay. It happens. Sell. And it's still down from its highs, even if it's now rebounding. Now, look, I think the stock simply took a breather. It was too hot, and now it's running again, but don't take it from me. Earlier today, we got this terrific chance to speak with Brett Schulman. He's the co-founder and CEO of Cava Group. He gets it. Take a look. Brett, I am so glad you have us here. I want to thank you.
Yeah, thank you for coming.
Of course. Now, what I see here is something that resonates. I see value, but I see premium. There is almost no one able to pull that off. Why is it working so well for Cava?
Well, I think it starts with our food, that unique Mediterranean cuisine where taste and health unites. And it's really at the nexus of these large secular trends we see where the country's getting more diverse. People are seeking bolder, more adventurous flavors, but they're becoming increasingly interested in modern health and wellness trends and the impact that the food they're consuming is having on their body. And that's where our food comes in. Mediterranean diet, #1 ranked diet for 8 years running.
Well, you've got this is a special store. And the reason I mention special store is you actually shot a commercial. And the commercial is for TikTok and for Insta. And people are talking about it. It's Gabby Thomas. I want you to tell us what it means.
Yeah, so right here at 350 Hudson, we did our shoot with Gabby Thomas, who's our collaboration partner for our new special curated bowls and pitas to start the new year. And the campaign is really about abundance, not restriction. And Gabby is a world-class athlete, a Cava super fan, a health advocate, and just a world-class human and an amazing representative of our brand.
Now, what she's doing, I think, is actually similar to what a lot of other people do, which is that they're taking in everything. This is not a transactional place. It's obviously a place of warmth. Just give me the choreography of a Cava store.
Yeah, so it goes to our Mediterranean way. That's certainly our bold flavored food, but it's also that welcoming hospitality where we want to welcome everyone to our table. And it's something we're working on through something called Project Soul, where we're really warming up our dining rooms with greenery, enhanced lighting, enhanced seating, because we don't think about it as an either or when you engage with us, either digital or physical. We think about it's an and. We want you to have your channel of choice to come in depending on what your need is in the world that day, whether you're in a hurry and you want to order on our digital channels or you want to come in and have that walk the line experience and engage with our team members and have that great Cava hospitality and then share a meal in our dining room with us.
It's funny because, of course, people know that Chipotle has a similar experience and they're always worth emulating. And we've got Ron Shaikh as part of the Bloodlines here. So there are many good things before Cava ever came. Now, I don't want to talk short-term numbers, because you're in the quiet period. But what you've done historically has produced well above average profit margins, incredible growth, and something that I guess works everywhere. This is a regional to national story, and there are many more states and places to put new kavas.
Yeah, that's what gets is so exciting for us. We're in 26 states in the District of Columbia. We're here in Manhattan, we're in Boston, but we're also in places like Fayetteville, Arkansas, and Fayetteville, North Carolina. So it works in the city, it works in small towns. And look, I think it's a testament to the broad appeal of that cuisine where anyone can come in, whether you're looking to have a vegan or vegetarian diet, or you just want spicy lamb meatballs and crazy feta. Everybody can come in, be satisfied, and walk out feeling better about what they eat.
Now, a lot of people are talking about technology and how it's making restaurants better. I like technology in order to be able to make it so that the make work people have an advantage when things go down in terms of the amount of food they need. But beyond that, the transaction and technology don't necessarily improve the experience.
Yeah, I think this is really important. We talk about technology or automation to enhance the human experience, not replace it. On our main serving line, you're going to see our human team members really delivering on that Cava hospitality and having that human connection because, look, as screens and automation and kiosks and all these things and technology infiltrate our everyday life and the front lines of many concepts, I think people are feeling that void of human connection and they're gravitating to places that are able to deliver on that. And as I said earlier, it's not an either or for us. We think we can have that great interactive physical human experience. And then if you want to opt into a digital channel, we have that for you too, but we put the power in your hands to opt into your channel of choice.
Do people have their own kava?
Yes. Everybody's got their home kava.
Okay.
But more and more, as we've spread across the country, we see them as they're in traveling or visiting family and friends somewhere else. They've got their go-to kava that they, when they see it, they know what kind of meal they're going to get. And so.
Well, that could also mean that they are loyal. You've got loyalty, and
Yes.
It's looking like that program is working spectacularly.
Yes. So we relaunched our Reimagine Loyalty program at the end of last year. It's something we've been wanting to do for a number of years, but we got to prioritize every year how many things we can do. But it's a new earn and bank points model, and it has a catalog of reward redemption options. So again, putting the power in your hands that you can earn and bank those points and then redeem them for your favorite Cava item or some new other rewards that we're excited to bring to you later this year.
Now, South Florida?
Yeah.
Tell me about it.
Yeah, it's coming in 2025. We're excited. That's one of our new big markets we're going to expand to. We're currently up in Orlando and Tampa and Jacksonville. We're going to move down into South Florida later this year. And then we opened Chicago last year, our first foray into the upper Midwest, and excited to have further expansion in the upper Midwest this year.
Now, I think you're still driving, well, of course you're driving innovation, but I want to talk about the new menu items. What steak, how's that working?
Steak's going great. We used to have grilled meatballs on the menu. We took it off, and we knew that our guests viewed that there was a perceived gap, that they wanted a beef item, a lean protein that they could opt into. And so my partner, Ted Zino-Christos, he's our chief concept officer, my co-founder. He leads our great, exceptional culinary team, and they worked to deliver a phenomenal steak product that's been incredibly well received and that is a permanent item on the menu.
Okay, so I think many people may say, who is this Brett? What is his background? Actually, you had kind of a back way to do it. You start with finance. You want to get things right, and that turned out to be a great way to be profitable. How come you went into the restaurant business? You could have gone to Goldman Sachs.
Yeah, it's a long, windy road, and I actually started waiting tables, helping to pay my way through college. Okay. So me and the guys, my three co-founders, are all sons of Greek immigrants, and all grew up kind of in the restaurant industry. And then after college, I went into finance for about 10 years, but I wanted to do something more impactful and build something that could have a positive impact on the people around me. And I met the guys, as fate would have it, and they had started this brand out of a single full-service restaurant with similar philosophies where they had mothers who worked in the restaurant industry and experienced the stereotype of how people were treated poorly. And so we wanted to create a brand where our team members could grow personally and professionally and have a career, not just employment, while making this healthful, great food that's solving a problem for our guests and making a positive impact on the communities we serve.
Well, let's talk about the line. A lot of people feel, listen, I want to get in and get out.
Yeah.
There is something to be said about a line and about sitting. It's not just to go. This is a good experience here.
We say fast enough, right?
Fast enough.
Fast enough. It's many.
That is worth thinking about for a second. Fast enough is what people are willing to pay a premium for fast enough.
Yeah, well, it's many people's first time interacting with our brand or eating Mediterranean food, and we don't want them to feel rushed or hurried. We're also mindful in many of our restaurants, we have lines to the door, and we don't want people feeling like I can't go to Cava today because the line's too long and it's going to take too long. So we also work behind the scenes to help our team members naturally move that speed of service, but we say speed and service. We can't have that speed come at the expense of the service. So we're always trying to strike that balance.
I just want to finish with the notion of health and wellness as something that people want in 2025. Resonating more than ever?
More than ever, and I think the key is people don't want to have to do it and make compromises or have restrictions. And that's where our cuisine comes in, where you can be satisfied, you can have this bold flavor food, and oh, by the way, you're eating better.
Well, I can tell you that the people at Mad Money may be your best customers. So thank you very much for offering what you do.
Yeah.
Brett Schulman is co-founder and CEO of Cava Group. Thank you so much
Thanks,
for the time.
Jim. Appreciate it.
Coming up, fresh off its earnings report, Cramer's checking in with the CEO of Levi Strauss to see if the company's stock is still in style. Next.
What do you make of these numbers from Levi Strauss & Company, the iconic denim company? Stock's been struggling since it reported a mixed quarter in early October, stabilized in recent weeks. So can this quarter change the narrative? Tonight, Levi's reported some of the best sales growth in years, up 12% year over year. Real strength in the Americas and Europe, as well as the company's direct-to-consumer channels. They delivered a much higher than expected gross margin. I love that record number. Because of some elevated expenses, though, they only delivered a 2-cent earnings beat off a 48-cent basis. I'll take that. More important, management's full-year forecast for 2025. Let's call it noisy. Top and bottom line numbers seem a little weak, but a lot of that's from divestitures, from currency fluctuations, tax rates. Shouldn't matter. I think it was good, but I'm not sure it was good enough. We got to talk to other people and see. Why don't we just talk to the CEO? How about that? Let's talk to Michelle Goss. She's the president and CEO of Levi Strauss & Company. Learn more. Ms. Goss, welcome back to Mad Money.
Hi, Jim. Great to be here. Thanks for having me.
Well, Michelle, it's been 1 year. It's been one year since you took the job. Why don't you tell us what's accomplished in the first year and what you think can be accomplished next year?
Yeah, you bet. Well, first, I'd say I couldn't be happier with how we're ending the year. You were just adding some comments around that, but we're finishing the year strong. Reported sales up 12%. But as we're now reporting, our organic growth up 8%. And that really is to take account of either one-time events or things like foreign currency headwinds, as you were just speaking to. So the 8% for us takes into account the exit of Denizen, exit of our footwear business, and importantly this quarter, the impact of the 53rd week. By all measures, it was a strong quarter driven by the health of our DTC business, wholesale returning to growth, strength in men's business, women's business, really across the board. And doing all this, as we complete this year, it really was a pivotal year for the company, starting the next chapter for Ellis & Co. As we become a full omni-channel retailer, we wire the company that way, and importantly, not just be about great jeans, but head-to-toe denim lifestyle. Well, and it's working. Our strategies are working.
I think it is. I'm glad that you brought up the DTC. I was, of course, perusing the site in advance of our interview. I saw a lot more than just jeans. Particularly a lot of cool stuff for men. Women, I don't know. I think some women who are in Lulu ought to be thinking about wearing jeans. I want to get your sense of where the customers are coming from and whether they're liking your additional offerings besides just traditional denim.
Well, based on the numbers, Jim, I think they like what we're offering. I mean, we really ramped up our innovation pipeline. We have a much more expanded, what I'll call lifestyle offering, but it's tops, it's bottoms, it's dresses, it's skirt, of course, all rooted in denim. But our consumers are giving us permission to play in a much broader market. And that's a lot of what's driving the women's business. I mean, the women's business was up 12% overall. 20% in our DTC channel, that's kind of the first mover. That's where we really get to bring the full expression of the brand. What's really driving the bottoms business is still loose and baggy. We're seeing that with women. We just introduced a new style called the XL wide leg. For men, while that trend took a little longer, we're also seeing that now drive the men's business with some new fits as well. So we're on our way. I mean, when I think about our results, certainly the top line, but we've also at the same time, Jim, been focused on the structural economics of the business, right? As we make this pivot to DTC, you saw our gross margins, record for the quarter at 60+%, record for the year, and we're planning for those to go even higher. So I would say this business is a lot stronger and healthier today than it was even a year ago.
Okay, I'm always concerned that I want more women's business because men periodically, all they sometimes they only want one pair. I mean, they're probably aggravating for you in some ways. But we watched the halftime show. We saw Beyonce. It's so obvious that when you have a song called Levi's Jeans, it's top of mind. What's your ideal breakdown between men and women? What would make it so you're the most profitable?
Yeah, well, we're making progress. So today our women's business is about 36% of our total business, but that should be half, right? When we just think about the broader apparel landscape, 36 is up quite significantly from just a couple years ago, but there's so much runway ahead. And it starts with bottoms. We are always going to start our business with great denim bottoms. But as we were talking, there's so much more where we can go for both men and women. And that's what's exciting to see. Even our tops business, which we've been on a big innovation journey on that front, growing in both men's and women's. And people historically haven't thought about Levi's for tops. They are now. We're becoming a destination for it.
Well, yeah, I was going to ask you also about belts. I mean, I think this is something my wife was saying, listen, we're wearing wide now. I'm saying, no, you're wearing skinny. People in the office are wearing skinny. But if you're wearing wide, you need a belt. And I know that Beyonce's wearing a Levi's belt. Can you make some money off those accessories?
Yeah. Absolutely. When we talk about head-to-toe denim lifestyle, we do see accessories as an opportunity for us as well. That's probably a little longer term, although we do sell belts today. But right now, our focus is really on those key categories like tops and dresses, outerwear. We talked about the fourth quarter, but Jim, I would just say we had a great holiday. So our holiday actually goes into Q1 a little bit because our fiscal year ends in November. So November, December combined, we were up 8%. And that was driven by the bottoms business, but also by everything else denim, including tops and outerwear, like I said. I have to also comment on your comment about Beyonce. We're early in our partnership with her. That's going to go throughout most of this year, and it's having an effect. I mean, these strong numbers we're posting, we are seeing a Beyonce effect. So we're very happy about that.
I have to believe that there will be a move away from the Lulus and toward you for both tops and bottom. Where do you get your new customers from when you see the women's position go higher?
Yeah. So I think there's a couple opportunities. One is to continue to drive more frequency with our existing consumers. We have data on them, and there's still a lot of room for them to visit Levi's 1 or 2 more times a year. The great news for Levi's is we are fully omni-channel. We've got our stores, we've got e-commerce, and we have our wholesale partners. So you can get Levi's in lots of great places. So we want to be there for our consumers anywhere they want to buy a pair of jeans. So it's existing customers, and then to your point, new customers. And I think the real upside for us is the female customer, both existing and new, and also the younger consumer. We've done a lot to drive relevance, and we're seeing that play out. And so when we think about the trends, which, I have to say right now in denim, it's sort of anything goes. Right. Loose and baggy are trending. That started with that younger generation, but everybody's wearing loose and baggy. Yet, there's still room to wear skinny jeans on occasion, and we see our customers still gravitating to that. So it's important for us as the category leader to be driving the trends, and I'm happy to say we are.
Well, I got to tell you, I was very impressed with the numbers. I love that kind of revenue growth. You're doing so much that is right 1 year in. Congratulations. Happy anniversary. Michelle Goss, President and CEO of Levi Strauss. I love it when you come on the show. Thank you.
Thanks so much, Jim.
Absolutely. Mad Money will be back with you.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the light round. Curtain round. Of course, I'm going to say, let's talk about bye-bye. So, just put it in a course, not sweat on my staff. Wait, this sound. And then the lightning round is over. Are you ready? Ski dad. Time for the light round. Curtain round. I'm going to start with Jim in Georgia. Jim.
Hello, Jim. I'm a club member, 3-time caller, infantry veteran, which will become that'll You'll understand why I mentioned that in a minute. I started buying defense stocks back in late 23 and did pretty well. Once President Trump was elected, though, there came to be this situation where you've got DOGE on the one hand looking for efficiency, and nobody's ever caused the military-industrial complex to be efficient. Nobody's ever called them that. And at the same time, it's a very dangerous world, and the defense needs to be caught up. So, and the only thing we've heard in specifics is the Iron Dome, which is, I think, a great idea.
And that's RTX.
Yes, and L3 Harris, Northrop Grumman, RTX, and then Lockheed Martin, which I'm asking you about specifically.
Okay, well, first, Jim, I want to thank you for your service, and I think your question, and being a member of the club, your question is an intriguing one. Lockheed Martin is a stock that, frankly, has come down so much that it's getting hard for me to dislike it with James Takelett at the top. However, I think the administration is far more focused on the idea of a Palantir-like solution to procurement, and that would be very bad for all the companies you just mentioned. So I do not want to get in the way of the Palantir buzzsaw because that's very close to Elon Musk, and that's where I am. Let's go to Dottie in Florida. Dottie.
Hi, Jim. How are you?
I am good, Dottie. How about you?
I'm great. First of all, I'd like to thank you for continually reminding us how to be good investors.
That's all I want. That's all I want.
I bought ADMA Biologics at about 14. It proceeded to go up to about 24 and then came down to 16. It beat its earnings last quarter. It guided up. It has strong buys and buys on it. Shall I buy more, sell, or hold?
Well, okay, so it does have earnings, which is terrific. It's not that much of a spec, and it does great blood plasma work. My problem is I don't have a catalyst. I think the stock at 40 times earnings is a little too rich. I would wait for it to come down before I would pull the trigger. Let's go to Tom in Ohio. Tom.
Booyah, Jim. Nice to talk to you again.
Yes, it is. It's great to have you on the show.
I was considering purchasing a stock called NovaCure, and what I like about it is their pipeline of pancreatic cancer drugs. I know you're probably going to tell me to buy Eli Lilly, but I already own it, and I'm looking to diversify and get some other biotech stocks.
I'll tell you, I used to be a very big fan of this company, but you know what? I have watched them for years and years, and they're not making money. And I just think that they should be making money. They've got good revenues, but they're kind of flat. Let's see some money made by NovaCure, and then we can get behind it. I need to go to Ben in Florida. Ben.
Mr. Cramer, did you have a good Sunday afternoon?
You bet I did. You bet I did. Thank you for referencing that.
I know if you're coming to New Orleans or not, but make sure that you get Nolan Smith and Jalen Carr on that plane. You're going to want them.
I will be there. I will be there to thank the team and thank you. How can I help?
Listen, I've been sitting on Keys, Keys, Keysight for about 2 years. Watched it go down. Bought some more to even out my price. I'm now about dead even. Should I hold on? Or
we want this one. We want this one. This is a company that has solutions. First of all, it's not expensive at all. And second, anything that measures reminds me of like Agile. That's another I like. They have a terrific business, niche business. I like it, and I think you should own it, and I think you should buy it. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, as dry January comes to a close, is now the time to invest in the wine and spirit stocks? Cramer's giving you his take next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
Somehow went from, I don't even know.
No, I
from
go.
Corning to
David,
Glassworks to Cats and Dogs to Pennsylvania.
David, just Google the road maps and you'll see where I'm going. You're on Uber. Switch. He's going on Uber. Well, one more.
We do need AI to say, what did Jim just say?
It all starts at 9 a.m. Eastern.
Just 2 more days. That's what the wine and spirits people must be thinking as we approach the end of this disaster of a month we call dry January. But we never knew it was going to be as dry as Death Valley or the Sahara. So will dry January lead into dry February? I don't know. I was praying that LVMH, company that represents the best of the best, would tell us they had a terrific wine and spirits quarter, putting this story to bed. But sadly, that's not what happened. Last night, LVMH, best of the best, reported a 36% decline in wine and spirits in 2024. Now, that's a number that must send a shudder through anyone involved in the liquor business. These are practically prohibition numbers. And keep in mind, LVMH has some amazing brands. Hennessy, Glenmorangie, Chateau Cheval Blanc, Colgin, Ardbeg, Belvedere Vodka. I'm giving them a pass on their high-end champagnes, Dom Perignon and Veuve Clicquot, because these are holding up. But that's not enough to support this entire business. Wow. Of course, LVMH is not alone. The numbers from Brown-Forman, which owns Jack Daniels, Woodford Reserve, Old Forester, Herradura, and the one we call El Jimador, are abysmal. Diageo's been a horrendous stock, befits a company that makes the Johnny Walker and all his cousins, the Captain, Tanqueray, Don Julio, Casamigos, Kettle One, Crown Royal, and Bullet. The wine and spirits from Constellation Brands are so challenged. I wish they just sold the business a long time ago. Just a very bad miss. Beer's holding up okay, but not enough to make Wall Street like the stock. Oh, man, that stock. Sell. And my charitable trust is stuck with it. The worst thing about all this is that, for the most part, not one of these liquor companies is willing to admit that they could be facing an existential threat. Like LVMH, they say we're experiencing a post-COVID normalization because of excessive alcohol consumption during the pandemic. That's why I say they're holding their breath to see if the mocktails and the zero-alcohol beers quickly disappear by Saturday when January comes to an end. Look, I think these companies are about to have a rude awakening when dry January turns into drier than expected February, and then we might even spiral from there. What's really happened to the alcohol business? Okay, there's this litany of these companies ignore. First, cannabis is so darn cheap, and in many states it gives you a legal high without a hangover. We're no longer living in a smoky and abandoned world. The future belongs to Harold and Kumar. Second, the Surgeon General just told us that alcohol is linked to increased risk of 7 types of cancer, including breast and liver cancer, among others. There's no safe level of alcohol consumption when we're talking cancer prevention. Not good for the heavy social drinker. Third, young people just don't like to drink as much as they used to. Some profess health worries. Others know that the liquor companies jacked up prices during the pandemic and now refuse to take them down. Fourth, ubiquitous GLP-1 weight loss drugs can stop your craving for alcohol in its tracks. The studies they're doing show that heavy drinkers seem to throttle back drinking when they go on Ozempic or Mounjaro. Now, that's a lot of serious negatives, so what's the hope? Now, look, I once ran a bar, and I've seen what's happened to my wife's mezcal. So my hope is that, like everything else, newness can crash through the ennui and the resistance. You have to create intriguing drinks. You know, kind of what they do with Breakers. You have to craft, let's just Chili's. You have to craft something. You have to craft the craft. You must have a value price point. I don't think enough people in the industry realize that the good old days of endless price increases and no resistance and zero creativity are over. I do believe that social drinking will always have a place in our lives. There's no way that we're phasing out booze entirely. But rather than thinking that this is just post-COVID normalization and expecting people to flock back after January, the much bigger fear is that alcohol joins tobacco on the list of things that can't be accepted by anyone trying to be healthy. I think alcohol dodged a real big bullet when there was no skull and crossbones added to the label during the Biden administration. Who knows what Bobby Kennedy Jr. might do if he gets the Health and Human Services job. No matter what, let's drop the normalization rap, please. This is not normal. The liquor companies need to be clever, thoughtful, and exciting, or they should just go find another business. Alex says, always bull market summer. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.